Hi there, welcome back to MacroMentors Outlook 2023 series. I'm here with Cristina Delgado. Cristina works as a portfolio manager for a commercial REIT, and we thought, given some of the things going on in the market, it'd be really interesting to find out from someone within the industry. Cristina, do you want to give just a brief background about yourself, and then we'll dive into a few things about REITs themselves?
Yes. Thank you, George. Yes, absolutely. So, my name is Cristina Gonzalez Delgado. I'm originally from Spain, but I'm based in London since several years now. I held positions as an analyst at Royal Bank of Canada and private banks at Saracen. More recently, I've also been working as an associate for a private equity real estate firm before I joined the real estate investment firm called Cromwell Property Group, where I'm currently working as a portfolio manager, specifically for their listed Singaporean REIT. And I hold a degree in business with a specialization in finance and an MBA specialized in real estate, and I speak fluently 5 languages.
Okay, so the most qualified person in real estate by the sounds of things. Obviously, one of the things, there's quite a bit of noise about REITs in the market currently, and I come from a more kind of speculative finance world, and we would look at things and say, especially the Federal Reserve and central banks are removing liquidity, and what you're starting to see is that property are kind of illiquid assets, and that what you're starting to see is that they're putting up kind of redemption walls. I know from kind of our conversations before that the mechanics aren't exactly there. Could you tell us a little bit about how it works? We've obviously had Blackstone, KKR, and Starwood kind of halt redemptions.
Yeah, exactly. Yes, we have seen actually at the beginning of December. So on the first week in December, actually, we saw like the value of the share price for Blackstone REITs like dropping 50%, and then at that point, Blackstone put some limits on the redemptions. But also we see some redemptions in other funds like Stargate. Just explain on actually how it works, because I think just let me to highlight. I think maybe for an investor who's not really aware on the how the REITs works, we have different types of REITs, and obviously Blackstone and Stargate are this category of non-traded real estate investment trusts, and that means they are not listed in the stock exchange. So compared to the public REITs, which are listed in the stock exchange, the public REITs actually have a committed capital. So if you become an investor in a REIT and you buy like a unit trust, the only way you have to exit is just by buying the shares to another investor. Whether in the private, the private REITs, basically the dynamics are slightly different. Both of them, yes, have been affected by the market volatility. But I would say in the case of Blackstone REITs, this has been more impacted by the market volatility. Also because the difference between the public REITs and the Blackstone and the Stargate REITs is that they are not marketed to institutional investors such as pension funds or insurance firms. They are actually marketed to high net worth individuals. So then obviously what is going to driven the redemptions coming from these investors are actually going to be different. In the case of, we will focus in Blackstone and Stargate. In the case of them, we see individual investors actually being affected by the liquidity crunch in Asia, and that basically causes financial distress. And as the CEO of Blackstone was saying, okay, the question is, what is driving, the investors claiming for redemptions? Is it market volatility, or is it actually the performance of the fund? In that case, we see actually, I would say basically 2 reasons. And one of the first reasons, as I mentioned before, was the liquidity crunch. So imagine that you, for example, an investor and you buy shares in or unit trusts, you are also holding margin debt positions, and the market fluctuates and actually goes down, that means, well, you will actually probably want to recover that money to cover for those positions. And also, that was one of the reasons, as it was explained in December by the CIO of Blackstone. Also because when we look at the performance of the fund, of the Blackstone REITs, the performance is actually been positive. So you have a net operating income, which is actually going up by 30%. You have also the NAV going up, even if we have actually also cap rates increasing because of interest rates and how the market is it's evolving. And we also have look at the performance of the fund, and the fund has performed positively on 9.3%. I think, positively year on year compared to the Dow Jones index that goes actually in decline on 22%. So we could then argue, obviously the drivers is not linked to the performance of the fund, because obviously the performance is actually being good. It's also being good because when we look at the underlying assets, we need to understand what the underlying assets, how they are performing. And it is true there are not liquid assets, but we will also look how those assets will be performing. And maybe for some investors looking at the cap rate, which is probably the most scary thing, where everyone is just looking now, like where the value of the property goes. Because obviously, I guess if you put your money in a REIT just to diversify and to have access to investments in real estate, the first thing you think about is like the price of the property. But if the price of the property actually goes down, the price of the REIT is going to go down as well. But in this case, we also look how those assets could be performing. So in the case, of Blackstone, we look at the portfolio, how the portfolio is composed. We see a lot of warehouses in strategic areas where it's going to be like a strong growth population. Also tenants with short leases. And besides, we have this inflation, and we feel, okay, this is actually something negative. Indeed, there is not. Indeed, there is an opportunity for these funds, and there is an opportunity in the sense that inflation will play like a positive role, because if you have short leases, you could actually increase the value on the properties, because you will just stop these leases and then signing new leases, because the assets are actually performing well. There is still demand. Tenants will be still, looking for space for the businesses, and then they will have to go into the market and actually to pay those higher rents.
Yeah, it's a little bit kind of like the WeWork model, I guess, where they borrowed really long and then they lend short to everyone. I guess to play devil's advocate, that makes you a little bit more exposed to kind of cyclical factors in the economy. You end up kind of, I guess, all on one side. I get one of the things that I think we've talked about previously is how do you as a REIT kind of navigate the interest rate changes? I know as someone who's trying to buy kind of residential property, that the volatility in the interest rates has really change, let's say, my affordability. I can only imagine that it must change your affordability. And I know that, parts of BREIT are hedged, but how does that then function for, let's say, new capital that comes into the REIT? Obviously it's a slightly different outlook. Borrowing rates are slightly different. Do you have any thoughts on that? How you think about it?
Yes, totally. I think, it's good something that you mentioned on the hedging, just to explain how the dynamics works, because, most of the REITs actually, they buy with leverage. That means they put equity and then they borrow money to buy these properties. So obviously, if the interest rates goes up, that will squeeze their returns, because well, you had to pay more in debt. But yeah, it depends on how you're heading. And for Blackstone, that actually was positive because they have interest fixed rates. So that means they're actually making a profit on the interest rate headings. So in the case of these specific REITs, they're actually covered, and the interest rates are actually playing in their favor. Then yeah, that's a good question on how it would be, for the new investors actually entering. And yeah, that's a tricky one because if you're a new investor and you wanted to put the money in the REIT, obviously, yeah, for this year, the REITs will keep, buying. We probably see maybe less traction because it would be more complicated to raise capital and to raise the capital at attractive interest rates. So I think one of the strategies could be potentially not borrow as much as money, but just trying to utilize the money which is already in the REIT to redeploy. So we actually could see potentially using sales to cover for a new acquisition, so just replacement of assets, and try to lower the amount of capital that you need to borrow. That will be, yeah, potentially kind of one of the strategies.
Yeah. Obviously, one of the trends that we've all kind of noticed over the last, I guess, few years, unless you've kind of been living in a cave, is that we've all been locked at home and we've all been able to work more kind of remotely, or as Armin kind of puts it, that, we've detached location from value. Obviously, on the surface, that should mean less people going to offices. Demand for office space as more companies move to some kind of hybrid or kind of fully remote setup. How do you think about that? Because obviously commercial real estate is a lot of that, I think, of people's office spaces. But you kind of mentioned earlier that warehousing was obviously becoming quite a big part of it. Do you see like you shift out of offices and you go more towards warehousing and things like that? How do you think about it?
Yes, that's a good one actually, because when I think everyone was like terrified during the COVID, like what is happening, trying to understand where the trend is, and it is true. I think in most of the case, I would think probably is your case. You have like a hybrid policy. You don't have to be in the office those 5 days a week. And it's for most of the companies that are having this hybrid policy. Obviously, that means there is a reduction on the space they need. But yeah, it's difficult to assess because it's like industry by industry. We have this tech and more like those companies were actually a bit more flexible. Some of the companies you see actually they are completely flexible. They don't have any issue with their employees like working remotely. Then you see companies offering this hybrid. So obviously all of this is impacting the way we use the office space. For we have seen now, I think it's still difficult to quantify on what the impact it has been. I think, going forward will be more like assessment on how the space is used, because it could be the case like, you still need like physical office. The question is whether this office is used to host people going there to work just in the desk, or it will be more like, okay, we organize, we leave the people working from home, and then we use the space maybe once per month where we gather together, and then we have these trainings, or we have just networking or things like that. So still, I think it's varied from company to company, and obviously just to answer the question on how we see like a shift between front office actually to warehouse. Also, my question is yes, and at least for us at Cromwell, this is what we are doing when we look at our REITs. Like since COVID started, we started to also make this shift more into logistics, because we think logistics is a stronger market than office it is. That doesn't mean office. Obviously, you buy like a prime office in London or in any other city with its prime location, that obviously will perform, because, as I said, the space is there. It will be probably 10 years of the way you use the space, but it will be still there. Obviously, you have to analyze property by property. I think the ones that suffer more, it could be probably secondary offices. But yeah, the switch is there because obviously you want to go into those assets which are having higher performance and a lower risk. And I think you had to decide between the asset that probably gives you the same performance, but with the lower risk, you will go into logistics. And this is what we are doing. We are seeing this shift into logistics more than probably investing in offices, and it's gonna continue. It doesn't necessarily mean that if you have a portfolio of 50% office, 50% logistics, it will become 100% logistics, but definitely it will be a reduction on the exposure that you have into this asset class.
And I'm right in thinking that the shift to logistics is really a function of effectively online shopping picking up in kind of regions where it's not so prominent. I think when we spoke before, the UK has quite a developed online kind of shopping culture, but parts of kind of mainland Europe, I think you said, were kind of developing. Is that the case? Is that how it works?
Yes. And I think you probably noticed like the difference between the different markets. And when you look at the e-commerce evolution into the UK, you see the graph is just basically, you see the UK is here, and then the other European countries are actually in the middle, just going up. What the COVID has done is just to accelerate that trend on the e-commerce. So e-commerce is also getting into other markets such as Spain, Portugal, Italy, that were quite behind the UK market, and obviously this is driven the demand for warehouses. But I wouldn't say e-commerce, and also in those countries it's e-commerce, and then it will be the last mile logistics. It is everyone now, and probably if you think about yourself, the way you were buying, right? You just buy something through Amazon, and then you expect to collect that purchase the day before, the day after, or even the same day. So this is where actually the trend is going, and it's going everywhere. Obviously, in the UK, because we was speeding up before with the e-commerce. The demand will be strong, but in the other countries as well. And we have seen, when we look at the graph during the COVID, it is true that pick up, because obviously, it was more e-commerce as everything was closed, was shut down. And it was also like assessments, thinking about how will develop. Will that be just specifically because of the COVID? And it's just pushing that, but it will go down. And it is true, will go down, but it's still going up. So the trend is there, and I think it's just from the way we shop.
Yeah, I think once Amazon Prime arrived in the UK, I think it was kind of a bit game over. It's very, very hard to beat something being delivered the next day. That's my experience anyway. I think from what I see, like my wife's family are Spanish, and they still have quite good brand loyalty to something English. I can't remember what the department store's called now. But like very big loyalty, go to the department store and buy things, which is quite different to how I look at kind of how my parents behave. They're quite online junkies now. One of the other things that's obviously starting to hit the real estate market is this kind of green rules. And I think everyone's trying to understand where the kind of rules sit in each individual industry. I know in London, there's a series of kind of rules coming in that you have to meet a certain sort of energy efficiency. Is that kind of creeping into how you make your investment decisions? Are you thinking about different assets because of that? How do you think about it?
Yes, I wouldn't really think about different assets in the sense of typology. So say you don't choose to invest more in warehouse or to invest more in office just based on that. I would say first screening is like which asset type it will be, or do you think it's less risky? And then obviously you will be investing in something which you have more certainty and security that it's gonna grow in value in the future, or it's gonna be demand, and then that's gonna drive rental growth. But it will be it is a focus on that, and you will be looking at those specific assets. So whenever you buy like an office or whenever you buy warehouse, yes, you will be looking at those properties from that point of view. So we basically have integrated the ESG into the investment decision process. And I guess mostly of the firms, they're picking up with that because regulation come into place, and it's just not regulation, it's just also when you think on the liquidity of the product that you are buying, obviously you just don't have to look in the short term, you will be looking long term, and this is the way it is going. So yeah, definitely you will be looking at those ones when you select your properties.
Yeah, I think I would speak for a large quantity of the kind of more like investment trading finance, where I think most people would say it's kind of right now there's no kind of there's a very hard benchmark to set, and everyone's trying to work out what kind of ticks the right box or what is considered ESG and what isn't. And I think that there's also this kind of thing where you'd expect kind of Bloomberg or S&P or something would have really like ranked everything and everyone would have agreed it, but it seems like there's still quite a bit of disagreement about how different things, what is E, what is ES, what is G. It seems like a bit of a minefield in kind of my world. Looking into this year, obviously you've said that you like kind of warehouses, specifically in kind of, I guess, the continental Europe kind of space where internet kind of shopping or last mile logistics is kind of picking up. Is there anything else that you think is kind of interesting? I know that you're mainly covering Europe. I know that Selwood were talking about Japan. They thought was quite interesting because you could get very low financing still and quite attractive yields. Is there anything else that you find attractive?
Yeah, well, I mean, if it's in terms of regions, I guess, yeah, as you said, I mean, I'm basically focused on specializing in Europe as a REIT that invests in Europe. So I don't really have that much experience into the other markets. But for example, yeah, in the US, it's exactly the same. You look at the logistics, and they basically look at what they call the Sun Belt. So it works exactly the same as here in Europe. You will be looking at those strategic points where they have good connections, where population is growing, where you have demand, etc. So it's really the drivers are really the same, no matter where it's Europe or other countries.
Okay, awesome. We'll probably kind of wrap up here. Let you go to bed for Sunday. If people want to find out a little bit more about the REIT you work for, where should they head? Is there a website we can go to?
Yes, definitely. Yeah, there is a website. So just basically, they can Google for Cromwell REIT, and they will just go directly to the website. And we have we have publications like every quarter's list. We publish like a result presentation where they can look at the performance of the fund quarterly. There is big pans of description actually on the assets the REIT is holding, also on the strategy. You could see actually how is the shift into logistic warehouses. There is a bunch of information that you can find about the REIT. So yes.
Okay, all right, sounds great. What I'll do, I'll add some text to the screen so everyone can have a link that they click to. Cristina, thank you so much for giving up your time. If you'd like to have a chat to Cristina, she'll be available on MacroMentors. We'll also leave a link to that in the notes below. But yeah, thank you so much for giving up your time.
Yeah, okay. Well, thank you, George. And yeah, obviously, do you have any other questions? Yes, available for any insights I could give.
Yeah, hopefully we'll do a follow-up maybe in 6 months or a year's time and see how warehousing's getting on. Okay.
Yeah, just to see how the interest rates are also evolving and how it's actually
Yeah.
impacting actually the investment pipeline.
All right, perfect. Thank you very much, Cristina.
Thank you.
Cheers.
Yeah, thank you.